Billionaires are pulling their treasure out of the Gulf in fear of a US-Iran war, sending their money to this safe country, Switzerland. In the silence of the night, the lights are still on in the luxurious homes of Dubai, Doha, and Riyadh. Outside, everything looks normal. The roads are shining, the skyscrapers are glowing the same way, the private jets are still lined up, and in expensive boardrooms, people are still smiling and shaking hands. But behind all this glitter, a strange kind of fear is crawling. Encrypted messages are coming in on phones, wealth managers are staying on calls late into the night, family offices are conducting emergency reviews, and the fate of billions of dollars is now being decided not just by returns, but by survival. The question is no longer where money will grow more. The question has become, if things get worse tomorrow, where will money be safest? And that question has once again turned the eyes of the world's richest people toward a country that is far from war, calm, rule-bound, and whose greatest strength is its old reputation, Switzerland. According to Reuters' March 13, 2026 report, Swiss money managers believe that amid the current conflict in the Middle East, wealth inflows from the Gulf into Switzerland may accelerate. This story is not just about bank accounts. It is the story of the psychology that is born every time a major war begins. When bombs fall, missiles fly, sea routes become unsafe, and oil prices surge, it is not just armies that move. Capital moves too. Money gets scared too. And frightened money always runs toward places where the law is strong, the currency is stable, banking has a reputation for confidentiality, and the political system is predictable. That is why, as tensions between America, Israel, and Iran grew, many high-net-worth families and private investors in the Gulf began rethinking their asset allocation. According to Reuters, the bankers and advisors they spoke to collectively represent more than $1 trillion in assets. And many of them believe that if tensions continue for long, fresh capital flow towards Switzerland could gather speed. Notice this carefully. This is not a sudden idea born overnight. Switzerland's safe haven image is not new. For decades, this country has been seen as a kind of financial fortress for global wealth. But the current conflict has activated that image once again. That same Reuters report said that, over the past 3 years, cash positions held in Switzerland by private investors and non-banks from the UAE had increased by nearly 40%. That means the trend had already begun before the war, but now tension has given it fresh momentum. Patrick Spiller of Deloitte Switzerland told Reuters that because of recent events, he expects wealth from the Middle East to move rapidly towards Switzerland, and discussions around this are already underway among banks, family offices, and wealthy individuals. This is the point where the story becomes even more interesting. Because the rich in the Gulf do not just protect money, they secure their future options as well. First cash moves, then securities, then structures, then residency-linked planning, then family governance. According to Reuters, Patrick Spiller estimates that several dozen $1 billion could come to Switzerland from this region, although it may take weeks or months to fully materialize. He also said that cash comes first, followed by stocks, bonds, and other assets. The meaning is clear. This is not a one-day panic reaction, but potentially a staged capital migration. First, people secure liquidity, then they do their longer-term positioning. Now, the question arises. Why Switzerland? There are other financial centers in the world too. Dubai, Singapore, London, New York, Hong Kong. So why are Swiss banks being discussed so much at this moment? The answer lies not just in banking secrecy, but in Swissness. According to Reuters, Swiss Bankers Association chief economist Martin Hess said that Switzerland's advantage lies in its Swissness, meaning a safe environment, political stability, and rule of law. In other words, when uncertainty rises in other parts of the world, Switzerland returns to its oldest brand promise: peace, stability, and trust. And that is exactly what becomes most expensive during conflict. In truth, war is not fought only at borders. It is fought inside balance sheets too. For ultra-rich families in the Gulf, the Middle East is not just a home region, but also a wealth generation zone. Their wealth is spread across real estate, oil-linked businesses, sovereign relationships, regional equity stakes, shipping, commodities, private companies, and family holdings. But when the region itself becomes the source of risk, diversification no longer remains just a matter of geography. It becomes a question of safety jurisdiction. In such a situation, a place like Switzerland, where the wealth management infrastructure is mature, banks carry a politically neutral image, and institutions have worked with the global rich class for a long time, becomes a natural choice. Reuters wrote that UBS and Julius Baer declined to comment, while Pictet said client inquiries had risen. That means demand is quietly building, even if banks remain publicly cautious in tone. The effect of this trend has not remained limited to private conversations alone. The currency market has also felt it. According to that same Reuters report, after the US-Israeli attacks, the Swiss franc reached a 10-year high against the euro. This means it is not just rich investors looking towards Switzerland. The broader financial market is also pricing it as a safety asset. When a currency starts strengthening like this, it sends a signal to the world. Money wants shelter here. Although one subtle thing needs to be understood here. Money running towards Switzerland is not always a permanent relocation. Very often it is parking capital, meaning temporary shelter for an uncertain period. Rich families may first place cash and liquid securities there, so that if the conflict in the region stretches out, if sanctions risk rises, if fear of asset freezes appears, or if questions around domestic capital controls emerge, they will have an overseas protected pool. After that, they move toward more complex steps like trust structures, custody arrangements, and cross-border tax planning. That is why, during wartime, the demand for private bankers and wealth advisors rises first. They do not just hold money, they build the architecture of uncertainty. This story also has a psychological angle. In affluent circles of the Middle East, wealth preservation has always been a major theme. But when major players like Iran, Israel, and America enter open conflict mode, wealth preservation suddenly becomes ultra-personal. Then the question is no longer, what is the portfolio return? It becomes, if things get worse, where is the children's education fund safe? In which jurisdiction is the family trust secure? Which bank is politically insulated? Which currency is more reliable? In such moments, investors may sacrifice return, but not certainty. So it would be wrong to understand this safe haven movement only through greed. It includes fear, status preservation, succession planning, and geopolitical memory all at once. And this fear is not baseless either. Reuters' recent reporting consistently showed that the Middle East conflict pushed oil prices sharply higher, increased market volatility, intensified inflation concerns for central banks, and pushed global investors towards safe assets. A Reuters report from March 17th said oil climbed again by more than 2% because the Strait of Hormuz remained largely shut and supply worries continued. Another Reuters report from March 12th said Brent rose to nearly $100 per barrel. When energy choke points are at risk, it is not just commodity markets that change. Wealth behavior changes too. Historically, Gulf wealth generation has been tied to hydrocarbons. So regional war risk is financially direct for them as well. Many people may ask, if the Gulf itself is such a rich region, then why is money leaving it? The answer is that richness and safety are not the same thing. A region may be rich, but if it is close to conflict, surrounded by shipping risks, exposed to political retaliation, or excessively concentrated in assets, wealth holders naturally move part of their money into safer jurisdictions. This is not a vote against any country, it is risk management. Just as a businessman does not keep his entire inventory in one warehouse, ultra-rich families also do not leave their entire net worth in one region. Especially not when war maps are glowing across TV screens. Switzerland's biggest strength is that it makes itself emotionally reassuring for wealth storage. According to Reuters, Till Budelmann, chief investment officer at Zurich-based Burgos Bank, said that the Iran war has also drawn European investors' attention towards Switzerland. He gave an example of a European investor who requested an immediate appointment to open an account right after the war began. That detail says a lot. Safe haven flows are not just a Gulf story. European investors too are looking toward the Swiss system out of fear of conflict spillover. In other words, Switzerland is now becoming not just a banking jurisdiction, but also a psychological refuge. Another important thing here is that a safe haven is not just a bank account. It is a whole ecosystem. Swiss franc, Swiss banks, Swiss law, Swiss neutrality, Swiss advisory networks. All of these together create the shelter narrative. That is why Reuters' March 1st, 2026 report said that, as trading resumed, safe haven currencies like the Swiss franc and Japanese yen firmed up, while the euro weakened. Then, in Reuters' March 17th currency report, the broader market preferred the dollar, but the haven character of the Swiss franc remained intact. That means sometimes flows show up directly in the currency, sometimes in bank deposits, sometimes in managed assets, and sometimes only in the inquiry pipeline. Wealth movement is not always visible in headlines. Many times it quietly unfolds in the form of private mandates. Now the behavior of the banks in this story is also very revealing. It is understandable that large Swiss wealth management institutions like UBS and Julius Baer avoid public comment. They do not want to send the wrong signal to clients or regulators by speaking too openly about geopolitical inflows. But Pictet's statement that inquiries have risen and that record AUM was recorded at year-end shows that the industry is feeling this demand from within. When financial institutions do not openly reveal numbers, it often does not mean that nothing is happening. Rather, it means things are happening quietly. Ultra-rich capital never crosses borders loudly. It moves discreetly. On the other hand, we should also understand that Switzerland's gain is not happening in a moral vacuum. When conflict rises somewhere, safe haven countries, banks, and reserve currencies gain commercially. This is the ironic face of capitalism. On one side, there are missiles, oil shocks, and regional instability. On the other side, there is AUM, deposit growth, fee income, and a stronger currency. Where war creates destruction, the financial system builds new pathways around it. That is why safe haven finance is such an uncomfortable field. It gives security, but it also thrives on that same insecurity. Even then, it would be wrong to assume that every Gulf billionaire will send all his money to Switzerland. Reality is far more nuanced. Many will adopt a diversified approach. Some share to Switzerland, some to Singapore, some domestic restructuring, some gold, some dollar assets, some sovereign exposure. Reuters reporting also points in this direction. The scale of inflows will depend on how long the war lasts. If the conflict cools quickly, movement may remain limited. If the war spreads, Hormuz risk rises, and oil and shipping volatility continues for long, then inflows could reach several dozen billion dollars. In other words, the future path will be decided by geopolitics, not just by the wishes of bankers. In this whole development, the Swiss franc itself has become a major symbol. When a currency reaches near a decade high, it is not just an exchange rate story, it is a trust story. Reuters directly linked the strength of the franc against the euro to safe haven flows. This also increased pressure on the Swiss National Bank, because an overly strong franc can hurt exports. In other words, safe haven status is both a blessing and a policy headache. Switzerland receives wealth, but its export economy also feels the burden of a very strong currency. That is why a Reuters poll discussed the possibility of FX intervention. Being a safe haven does not come free. It carries a macroeconomic price as well. If we look more deeply at this story, it is not just about Gulf billionaires, but also about global capitalism itself. When uncertainty rises, the world does not get scared equally. A poor person starts stocking goods, the middle class worries about fuel and bills, and the ultra-rich simply change jurisdictions. That is the real power of wealth inequality. What an ordinary person cannot do, a rich person can do overnight. They can move their cash, custody, advisors, tax plan, residency option, and banking access somewhere else. That is why the fear of war does not touch everyone equally. For some, it is a survival question. For some, it is a portfolio relocation exercise. Perhaps that is why this story of potentially billions of dollars moving from the Gulf towards Switzerland is not just a finance story, it is also a power story. It tells us what the greatest luxury in the world really is. Not a private jet, not a yacht, not a palace. The greatest luxury is options. And in this period of conflict, the ultra-rich in the Gulf are using exactly that luxury. They are asking, if things get worse, which door remains open for us? And at this moment, that door seems to be opening towards Switzerland.
Has taught you something new. Do not forget to like and share this video so that this information can reach others as well. Your likes and shares are a source of inspiration for us. If you have any questions or suggestions, please let us know in the comments. It will be our honor to answer your questions and listen to suggestions. And yes, if you like our content, subscribe to the channel and press the bell icon so that you stay connected with every new story. Thank you. GRT Business YouTube channel sources, news from various news agencies, opinion polls and other public sources. We try to ensure that every report and summary is accurate and verified, but we are not responsible for any dispute or error. Our aim is only to provide you with accurate information.